we're going to have that many more problems to solve. And the earnings and revenue growth rate of problem solvers far outshine the economy. So,
do you agree that we're going into a recession, like Jamie Dimon, by so many economists? You do agree?
So I think we're in one. And I think we've been
already.
in one since the beginning of the year. In the U.S., we had 2 down quarters, interrupted by a positive here. But that was imports coming down, inventories, because inventories are too high, so imports are coming down. That's not a great recovery. It's not a recovery. We're in recession.
So already all the people predicting are still predicting. You're already saying we're already in here. But okay, so that begs the question. Betting on tech, your flagship ETF, your flagship fund, soared 150% in 2020, but it's now down a whopping 75% from its February 2021 high. So given what you just said, that this is a time to invest, let's talk about hedging. Should you have done more of it then? Should we do more of it now?
So ARK does one thing. We don't pretend to be an asset allocator. Our clients are the asset allocators. And our clients decide for their clients how much risk. Well, what's fascinating about young people today is many of them are natively digital, natively interested in technology, and understand that technology does solve problems and make our lives better.
But do they understand the risk?
I think they certainly do after the last year and a half. But even before that, as we were going into COVID, in a 1-month period, we were down 46%. If you look at ARK's entire lifespan, its fund span, roughly 8 years now, you'll see that there have been risk on, risk off periods. And our client base, our asset retention has been phenomenal because our clients know that you average down into periods like this. And they also know and are learning as they study the various benchmarks and indexes out there that they don't have the kind of disruptive innovation that our funds do. We are a great diversifier. We think most individuals and institutions are short truly disruptive innovation and that we can help diversify them.
Now, why are you so sure about this? Based on what?
Based on what? The last 20 years, 22 years have been characterized increasingly by a shift towards passive are kinds of strategies, the disruptive innovation with NASDAQ 100, for example. They are not. If you look into that index, which you find FANGs, NVIDIA, good company, Tesla, we own the last 2, but we have not owned the FANGs for quite some time in our flagship strategy. And if you look down below in the other 50% of that portfolio, you'll find food stocks, you'll find brick and mortar retail, you'll find utilities, you'll find energy.
But that's to make things safer in the long run, to diminish the risk usually.
You know what? If people want innovation, they should invest. Someone should provide them with innovation and not a hedge. Their advisors can hedge, or they themselves can hedge. You can hedge with cash as well.
Are you suggesting that traditional houses that sell these kinds of products are doing less research than you? Are you suggesting that your research is somehow better than theirs? I mean, we know that you have broken the mold in terms of using social media and other platforms to essentially be transparent in a manner that is unknown in the industry. But what makes your research any better than anybody else's? And especially when we talk about these big names that are offering these products.
Well, if you think about innovation that's going to disturb the traditional world order, who are the big banking clients, which include 14 different technologies, all evolving at the same time, and S-curves are going to be feeding S-curves as they converge? Then the traditional world order is going to be, we think, severely disintermediated, if not destroyed.
Okay, if I think long ago, humanity has moved away from people who could tell them the future based on crystal balling, right? Could look at the crystal ball. So you're talking about having some sort of access to understanding the future. So talk to me about what focuses, where you're focused in terms of what you think is going to be transformative. What areas are you really focused on?
Well, first, let's discuss how we get there. We focus on something called Wright's Law. Wright's Law is a relative of Moore's Law. Moore's Law is a function of time. Wright's Law is a function of units. And Wright's Law is working better in the semiconductor industry than Moore's Law is these days. We center our research around understanding how technology learning curves are going to translate into cost declines and how soon these technologies will become inexpensive enough for broad-based access. So that's what we do, technology by technology. The 5 major platforms right now are, one, we used to call it DNA sequencing, or the genomic revolution, is providing us what the internet was lacking when we didn't understand that it would involve commerce. And if you look at the cost declines associated with each of these technologies, you look at, and Wright's Law says for every cumulative doubling of units produced, costs decline at a consistent rate for each technology. DNA sequencing, 40%, or if you're talking about long-read sequencing, 28%. Robotics, 50%. Battery technology, 28%. Artificial intelligence, I just mentioned. We're getting our arms around what this is, but AI training costs dropping 60% per year, and these breakthroughs, astonishing breakthroughs. Their first exposure to it was in the tech and telecom bubble, and that ended badly. Investors were flocking. That was the time to say, wait a minute, the technologies are not ready and the costs aren't low enough yet. This can't happen. Today we're saying, hey, the technologies are ready. The costs are low enough, and you've got investors not running into these technologies, but running away from them, which, by the way, I've learned from very early in my career. If everybody is looking in this direction and thinks this is the way it's going to work, and you see evidence building, data building, suggesting this is the way it's going to work, you're going to make a heck of a lot of money.
What's the time horizon?
Time horizon.
How long?
Is 5
How long
years.
do people have to keep their money in this investment? And by the way, just give me the number, because I need to ask you one more question before we finish. We're running out of time.
Sure. Number. So we believe
how long do people have to
5 years is our investment time horizon. We believe these technologies are going to scale in the global equity markets from $8 trillion now to $210 trillion by 2030. And if you want to see the building blocks for this, go to Ark-Invest. Our big idea is 2022, and you'll see the building blocks for that $210 trillion number. He knows how to do this. He knows how to do this.
But does he understand how to do social media? Does he understand how to do outrage and deal with the reality? People are quite concerned as users about a kind of darkness seeping into Twitter that is there, but maybe not in the amount that it will be based on what he's been saying. Yeah, what are your thoughts about that? I
think the darkness was in their opacity, Twitter's past. Like, we didn't see the algorithms and how they were working and what they were.
So you think it's going to make it more transparent?
Open source, transparent. This generation, we know this. We built Ark on top of transparency and true democratization. They want the transparency.